Ntombenhle, after another poor start to the session this morning, we've had the euro strengthening in the past hour, and that was on news of the European Central Bank's tender results, and that's been one of the factors driving down our markets, the fact that emergency liquidity was being withdrawn from European banks.
Yeah, I think, it just initial reaction there I saw was a lot more confidence in the market that the ECB was doing that. But yeah, so I think it was a better way and a better time for our market when that was announced.
Of course, we did have that big sell-off yesterday. Our market down 2.2%, and that was really little compared to what we saw in other markets. We had the S&P 500 down 3%. I mean, just looking at some of the concerns that are coming into the markets at the moment, we had China's leading indicator revised downwards. We had those US consumer confidence numbers also coming out much worse than expected. So it looks like there is a lot of caution in the market at this stage.
Absolutely, lots of risk aversion back in the market. I think, the double dip recession rumors are becoming a little bit more of a reality now for people. I think sentiment is that, the recovery is going to take a lot longer than expected, that it actually isn't as strong as initially thought. I mean, for the Chinese growth to be revised to 0.3 from 1.7, I mean, that's a massive move. So I think just the market, really wanted to step away from it, let things sort themselves out. Lots of risk aversion back. We see commodities also reacting accordingly, especially because China is a big consumer of commodities. So we saw a little bit of a pullback there. But the gold price is still bid because it is viewed as a safe haven, or it does have safe haven status. But yes, lots of risk back into the market and risk aversion.
There seems to be a case of be careful what you wish for, because a couple of months ago there were concerns that the Chinese economy was overheating. Chinese government taking steps to slow down that in case a bubble formed. So as soon as we get the first signs of bad news coming out of China, it looks like everybody running for the exits.
Absolutely, Stephen. What they tried to do with the real estate sector, also, trying to put in some cutting back measures there, instead of government spending. We saw a lot of cutbacks there. But yes, the market is looking for negative news. The bears are out, and as Alicia mentioned earlier, I think maybe it might present an opportunity for people to pick up shares cheaply, but, cautiously so at these initial stages.
Of course, those consumer confidence numbers out of the United States, and I think we had a dip to 52.9 in June. That was from a downwardly revised 62.7 in May. And that follows poor housing data last week. We had existing home sales and new home sales much lower than expected. So it looks like the US consumer also still not in a very good space. And I should imagine all eyes really on that jobs data that's coming out on Friday.
Absolutely, non-farm payrolls, all eyes on that. I mean, we do have the ADP employment change that maybe gives us an indication as to what's going to happen on Friday, but all eyes are on Friday. I think players are just waiting at the sidelines to see what happens on Friday afternoon in our market when we hear what the figures are. But there is a contraction expected. But I think everybody's just expecting things or hoping that things will be as expected. If it's out of expectations or out of line with expectations, I think we'll see a very, very big reaction to it, but a very big negative reaction to those numbers.
Of course, we have quite thin markets at the moment due to holiday season in the Northern Hemisphere. To what extent do you think is that exacerbating the moves we're seeing on the markets?
Yeah, it takes out liquidity in the markets, a lot less players in the market. You don't know where it's there. I mean, we can see it in our markets at the moment, volumes at about 8 billion versus the 11 billion that we usually do in the year. I suppose also people may be taking time off for the World Cup or on holidays, with longer school holidays. But I think when players are out the market, liquidity leaves, and of course then it's very difficult to gauge a kind of direction or a more believable direction in the market. So we're seeing that way it's actually just self-fulfilling, really, with this contraction, and any reaction to bad news is just overemphasized and there's just overreaction in general.
Well, we had a tiny bit of good news in our market this morning. Private sector credit extension numbers coming out. Credit lending slightly better than expected, although money supply is still under pressure.
Yes, absolutely. I think, this it just goes, the money supply numbers just goes to show that, there is a slow pace of recovery in the South African economy, that it's not smooth sailing just yet. And, as much as, yes, the private sector number went up, and for the first time in about 7 or 8 months in South Africa, we don't know whether this can be sustained or whether, this will be the trend going forward, because, household debt is still high. Unemployment, or the threat in unemployment, is still high, and the World the world economy recovery is still not as robust or as strong as people initially thought. So there are still some fears there, and bank credit lending, it has been eased, but still current debt levels have not subsided to levels that people would be confident in.
Ntombenhle, we're getting the trade balance figures out at 2 o'clock. What's the market looking for over there?
I think the market is looking for about a contraction of 2.5 to 2.9 billion, and I think also, especially as far as we're concerned, we're hoping that expectations that our expectations will be in line with the final numbers, because any surprises to the downside will definitely have an adverse effect on the rand. We'll see an initial a big knee-jerk reaction to to those numbers, and also considering where our current account deficit numbers were sitting, I don't think it will bode well if it has widened further than expected.
Ntombenhle, today's the last trading day of the first half of the year, and all of the gains we've made this year have been wiped out. We're back at last year's levels. Expectations for the second half, do you think we're going to have more of the same, just given the very cautious outlook?
Sure, Stephen, I do expect that, it will be more of the same. Perhaps, I think before economists were expecting that the United States would start raising rates towards September, the last bit of the year, but I don't think those things will happen anymore. I think it has been a very tough showing for the market this year. Volatility is, has risen. Even just yesterday, with the U.S. consumer confidence numbers, it went up 22%. So, I think that volatility will be a major factor in the market. I think that there will be a pullback, perhaps a little bit around about these levels or slightly above, but certainly not where we started off the year. And I think it just will be tough going forward.
Ntombenhle, it's been great chatting to you. Thanks very much for your time today.
Thank you.
Ntombenhle Radebe from Nedbank.